Okay. So, iNRI is a one-stop financial platform for 35 million global Indians. Along with multiple products, we offer US tax, and this is the focus of the webinar. So, I kind of want to double down on what we do with respect to US tax at iNRI. We offer both planning and filing services. What we have traditionally observed, and even myself, as someone who's living in 8 years in the US, I've realized like taxes can get complicated, as you spend more time, as you're making more money, and how to kind of, do it the right way. And essentially, it means that you first obviously have to have the right knowledge or find the right person who can do it for you, right? And you can imagine the world on the left side, without INRI. Obviously, there are platforms like TurboTax, HNR, and then you have CPAs. But as you kind of, your complexity increases for the tax side, generic platforms do not really help you. And then working with CPAs could be very difficult sometimes. And it is definitely expensive depending on, the workflow they have. And sometimes it's also a longer process, right? But with INRI, we believe that there is a better solution that should exist. We want to offer proactive strategy and not just filing. So we don't want to be just transactional, but really be a trusted partner for you. Secondly, we believe that AI is finally here to make things easy for everyone, right? And I think taxes is also going to be disrupted soon with AI, and we want to be the forerunner here. Lastly, I think we can definitely improve on the current experience you may have with human CPAs, and we want to kind of build in the modern digital experience with, obviously AI, and but also include the CPA as part of it. So quickly getting into the agenda today, Jeff's take on advanced tax strategies, and followed by Q&A. Feel free to type in your questions in the Zoom chat as they come up, and we'll take them, during the Q&A. So over to you, Jeff.
Great. Thank you. Why don't I take over sharing my screen here? Very quickly, I appreciate the introduction, Hemant, and so I'm with Valor. You can see the logo in the bottom right there. Valor is also a startup aiming at helping people like you reduce your taxes. The angle we take on this is that we partner with CPAs, with financial advisors, with companies like iNRI, to take the ball, the kind of the next step after Hemant and his team have solved your tax filing and kind of structuring and setup issues. We then focus on advanced strategy. And specifically, we work on a variety of entities, vehicles, investments that you can use to reduce the tax on your earned income. We'll talk about this, but I'm including everything W-2, RSUs, business income, partnership, as well as capital gains from the sale of appreciated stock, cryptocurrency, whatever appreciated assets you have. So that's what we're going to be talking about today. I'm going to be focusing on those two categories. Although Hemant introduced me, I'll just add a little bit. I am part of the founding team at Valor. I'm a lawyer by background. Our team is a mix of lawyers and CPAs and financial advisors who focus on building out these strategies and teaching them, explaining them. We also then help you and your CPAs here to actually implement these strategies. So we're here to educate, to help you plan, to model alongside our partners here at iNRI, and then to actually implement these strategies. And so if anything that I talk about here today is interesting, Hemant and Dinesh and we will all work with you to evaluate the strategies, figure out if they're a fit, and then actually put them in place for you. So, what we're talking about today is tax planning for capital gains and ordinary income. First thing I want to do is spend 1 minute just making sure we have these key concepts down together. Um, I'm sure you all have this in your pocket, but just to make sure, I'm going to be distinguishing ordinary income from capital gains. Those are two different types of income that are treated differently for US tax purposes. Ordinary income, as I said, is the money you earn from your job, the salary, money that you earn from running a business, from being a partner in a law firm or a medical practice. Really anything that you have earned in exchange for doing something. And that income is taxed at the very highest rate in the US. So the federal ordinary income rates range, but they go all the way up to 37%. And at the state level can be as high as 13 something percent in California and New York. On the other side, we have capital gains income. This is income that you get from selling an asset that has appreciated. So you buy Apple stock or you receive an RSU from Amazon and that gains value and then you sell it. You're going to pay capital gains tax on the gain that you have there. And that's taxed typically at a lower rate, somewhere in the range of 15 to 24% at the federal level and then also with state tax. So we're talking about both of those today. I'm also going to talk about deductions versus credits, which is a concept that I'll get to, and withholding and refunds, but I'm going to just speed through here and really get to the meat of the presentation. So let's start with capital gain planning. And Hemant, Dinesh, I can't see the chat, so if anything comes up, if anybody has a question, just let me know and I'll take them as we go. So we're talking about first about capital gain planning. As I said, this is most commonly for the audience here and for people like you, we're talking about income that you've gotten from selling stock that you bought or you received for working at a company, whether it's a startup or a bigger tech company. This could be an asset that you bought, real estate. This could be cryptocurrency, a share of a private fund. This is any asset that has gained value. So this applies to really everyone who's growing wealth in this country. The strategies that Valor helps with, there's a range, including, as I list here, charitable remainder trusts, exchange funds. You'll hear talk of things like opportunity zones, pooled income funds, and many other things. We've done the math, we've done the back testing, and our view is that charitable remainder trusts are the right place to start for the large majority of people who own these kinds of assets. And so that's what I'm going to focus on and what Hemant and the team asked me to focus on today. So what is a charitable remainder trust? This is a vehicle, a CRT is a vehicle, an entity, an account that holds assets. Like, I'm going to use Apple stock as the example throughout here. It holds these assets, and a lot like an IRA or a 401k that you have through your job, the assets in this trust grow and can be bought and sold tax-free. So let's say you take some Apple stock that you bought when it was worth, let's say $100,000, and now it's worth $1 million. If you didn't use any vehicle and you just sold that stock, you'd be paying tax on the gain, on the $900,000 difference between what you paid and what you sold it for. You might owe something like $300,000 of tax, and you'd get to keep, let's say, $700,000 and reinvest it. And so you'd be starting with a smaller amount than what you sold. If instead you do this through a charitable remainder trust, you move the Apple stock into the trust before you sell it, a few things happen. First, you get a tax deduction for doing this. You get a 10% deduction. So if you put $1 million of stock in, then you get to reduce your taxable income, including your W-2, by $100,000. That's a very nice thing. I like to mention it. It's not the focus here. The main benefit of a charitable remainder trust is that once you've moved that $1 million of Apple stock into the CRT, when you then sell it, which you might want to do to diversify your position, to take gains off the table, there are lots of reasons why you might want to sell. When you sell, instead of paying those $300,000 of taxes that I mentioned earlier, you'll pay zero at that moment. And so instead of having $700,000 to reinvest, you'll have $1 million to reinvest. As you know, the value of reinvesting a larger amount is that difference compounds over time. And so reinvesting $1 million instead of 700,000, that difference is going to get bigger and bigger. And that's the main value of this strategy. So you put the stock in, you sell it, you pay no tax, you grow it, totally tax-free as you buy and sell assets. You reinvest the cash from the Apple stock basically however you want with some limitations that we can talk about. But you reinvest, it grows, you buy, you sell, you rebalance, and you pay no tax until you take the money out of the trust. How do you get money out of the trust? Well, it owes you an annual distribution. which you can take or you can defer. I'm not going to go too deep on how exactly this works today. Happy to answer questions or do another session where we go deeper on the precise mechanics. But the basic idea is the trust is going to pay you somewhere between 5 and 11% of its assets at the end of the year. And when that money comes to you, it will be taxed. So this is all about deferring the tax, putting it off, not eliminating it entirely. But by putting it off potentially for many years while you defer those distributions, you can grow the money and it'll get much, much larger. So you get that deduction, you sell tax-free, you take distributions over time, and then whatever is left in the trust after you've taken all of your distributions and at the end of the trust's term, which I'll talk about in a second, whatever's left there will go to a charity that you choose. Okay, that could be your family's donor advised fund, it could be a family foundation, or it could be an existing nonprofit that's registered here in the US. Um, the big picture here, I'm going to talk about some nuances, but the big picture here is you get to reinvest the money tax-free, take distributions over time, and overall, for taxpayers, especially in high tax states, we see somewhere in the range of 2 to 5 times the total after tax returns over the long run when you do this as compared to when you don't. So very powerful strategy. There are some nuances that we'll talk about, mostly having to do with that liquidity limitation, the percentage that you're getting. But strictly speaking, based on the returns, this is a very positive and powerful strategy. As I mentioned, this works.
Jeff,
Yeah, go ahead.
sorry to interrupt. I think there are a couple of questions on CRT.
Yeah, please.
Can it hold real estate? And the other one was, are there any restrictions on what can it be used for?
Yes. Good questions. As you can see, I was about to hit one of those questions right here. The trust can be used to defer the gains on any appreciated asset, including public stock, startup equity, crypto, real estate, and more, right? Collectibles, LP stake in a fund, really anything that has gained value. So yes, absolutely, it can apply. There are some specific rules for each of those categories, but nothing that changes the overall picture. And then the next question was, what can this be used for? I guess there are two ways to take that question. One is, how do you reinvest? And another is, what can you do with the income or the distributions? Taking the second question first, what can you do with the distributions? The answer is whatever you want. That's your money. The money comes out of the trust and it comes to you as income on a K1. And you can take that and spend it just like you would if you had received income from a job or anywhere else. How can you use the money to reinvest after you've sold that initial asset? It's only slightly more limited. The main idea is you can reinvest the assets in any asset class that you could invest in otherwise. As I said, all of this list, really anything you want. The only limitations that really matter for most investors are one, the trust can't use its assets as collateral for a debt. And what that means practically is you can't buy a property and take out a mortgage using that property as the basis for the mortgage, as the collateral, right? So if you're buying property or putting property into a CRT, it has to be free and clear, no mortgage. And then also you can't trade on margin, right? You can't borrow against your stock to trade. And then the second big limitation is just that you can't do something called self-dealing, which means you can't use the trust assets for your own benefit until you've withdrawn the money. So you couldn't buy a house with the trust assets and then live in it or use it as a vacation home. Beyond those two restrictions, there are a few more, but nothing that really practically matters. For most of our clients, they're taking their money and they're reinvesting in the public markets, in startup equity, angel investing, crypto, real estate, and there's very little restricting what you do there. Does that make sense? So I know we're aiming to be done kind of 7:35 or 7:40 to leave time for questions. So I'm just, as I mentioned, the returns here are quite large. Maybe during the Q&A we can come back and I can talk about some of the nuances, some of the kind of decisions that you have to make here to design these trusts. But I'm gonna leave this for now and turn next to ordinary income, if that makes sense, Hemant. Is that okay?
Yeah, sure. Sounds good.
Okay. Oh, and sorry, the last point I want to make before I forget. When you're planning to use a charitable remainder trust, the absolute key is timing. You have to set this up, and then you have to move the assets into the trust before you sell them. Absolutely can't do this after you've sold the assets. So we often hear from clients who come in and say, "Hey, I sold my Apple stock earlier this year. What can I do?" And the answer is there's a lot you can do, but not a charitable remainder trust. The most powerful strategy requires that you do this before you sell. Fortunately, Valor, working with iNRI, can set these things up very quickly and efficiently, and in fact, for free. We don't charge anything for setting these up. And as a result, if you come to us and say, "Hey, I really want to sell my Apple stock later this week," or "I'm selling my house, I just listed it on the market, I need to get it into a trust," we can do that. That's not a problem. You just need to make sure that you're on top of it and get it done before the sale. Uh, Next major topic, completely separate from capital gain planning, is earned income planning. As I mentioned at the outset, this is planning for, I'm just going to skip ahead here. This is planning for any kind of income that you've earned from working or from running a business. So things like your W-2 income from your job, RSUs that you've gotten from your tech company, partnership income from working as a lawyer or a doctor or a dentist, and business income from running your own business and taking profits or taking money off the table via your S corp or your LLC or even your C corp. That's the category of income that I'm talking about here. And as I mentioned at the outset, this is the highest taxed income in the US tax code. So it's critical that we find ways to reduce that tax. It's also, as the guys at iNRI know, this is the hardest category to plan for. The IRS is very good at taxing earned income. And so the options here are more limited. Fortunately, there's one that is quite powerful, and that's what the guys invited me here today to talk about. Specifically, that is something called solar investment tax credits, or the solar tax program. This is a federal and state program that offers significant tax breaks, tax incentives in exchange for you uh, putting your money into green energy. So Congress over the years has decided they really want people, including regular people like you and me, to take our money and build solar panels, build wind turbines, build other green energy infrastructure. And to get us to do that, they offer very large tax benefits. What are those benefits? So I'm going to be working under the assumption that we're talking about $100,000 put into one of these projects. That's on the smaller side of what people have done with us and our partners like iNRI, but it's just a good round number. So let's assume that you put $100,000 into one of these solar projects. You are going into a partnership with a solar developer, and they are matching your capital. So you put in 100,000, and the developer puts in 100,000, and together you are investing in, you are building a physical solar installation somewhere in the US. This might be an array of rooftop solar panels on top of a community building in New Jersey, or a grocery store. We do a lot of these projects on top of grocery stores, convenience stores, Wawas, and things like that. It might be on the roof of a residential building, like an apartment building or even a house. It might be on a university in California or in Iowa. All kinds of projects. The idea is, though, that you are taking your cash and helping to build one of these actual physical solar projects. And in return, you get three things. The first is you get a tax credit. Tax credit is, you've come across this in the context of, for example, the electric vehicle credits or the child tax credit. What you're getting here is if you get $1 of credit, you are reducing your actual tax owed by $1. It's not a deduction where you're just reducing your income, but actually reducing your tax. And those tax credits are somewhere in the range of 40 to 50% of the project size. And as I said, you're putting in 100,000, the developer is putting in 100,000, which means the project is worth 200,000. And through a little bit of legal wrangling, you are able to claim let's call it a 45% credit on that whole project. So if you put in 100,000 and the project is worth 200,000 and you're getting a 45% credit, that's a $90,000 credit, which means if you put in 100, you are saving 90,000 on your taxes right away. Very easy, with no dependence on the performance of the project, no investment risk. This is just a tax credit that you get back. You put in 100, you get back 90 right away. Very straightforward. And you'll get that at the very latest when you file your taxes in the following year. But the team here at iNRI can help you when you're filing and when you're doing your withholding over the course of the year. You can actually reduce that withholding and claim some of that credit earlier in the year. But very, very latest, you'll get that $90,000 back in April. In addition to that tax credit, you get a depreciation deduction. Those two words are both important. What is depreciation? Depreciation is the concept that physical assets lose value over time. So if you invest in real estate, the assumption is that the physical building loses value over time because it breaks down, there's wear and tear. And with solar panels, the assumption is that the solar panels lose value over time. The deduction concept here is that the IRS lets you deduct the value, that lost value, that depreciation from your income. And so if you put $100,000 into this solar thing, and the project is worth 200,000, your depreciation deduction at the federal level is going to be somewhere around 80% of that project size, which is 160% of what you put in. So if you put in 100,000, the IRS is going to let you deduct about 160,000 from your federal taxable income in the first year. So if you make $1 million and you're able to, and you're paying, let's say 50%, or let's say 37% federal tax, you're paying 307, just to keep it round numbers, you're paying $300,000 in federal tax. Now let's say you take a $160,000 deduction, and now you're only making 840,000. Well, now you're probably only paying about 230,000 of tax. So you've saved $50,000 to $70,000 of federal tax based on that depreciation savings. In addition, you get to take state level depreciation. You get to deduct that value from your state income spread out over 5 years. A lot of numbers here. If you're interested in this, you'll get in touch with the iNRI team. They'll bring us in and we'll go through this. We'll build a model for you. We'll look at it very precisely. But the big picture is, in the first year of these projects, if you're in a high tax state, you can expect something in the range of 125% federal tax savings. You put in 100, you get back about 125 in federal savings. In addition, over the course of 5 years, 40 to 50% state tax savings. So when you add those together, in the first year, you're getting about 130 to 140% total tax savings in the first year. You put in 100, you get back, let's say, 140. So you got back your initial 100 that you put in, plus a 40% return or tax savings. And then in addition, another, let's say, 30 or 40% of state tax savings over the next few years. In addition to those savings, which are substantial, right? You're putting in money and you're getting back much more than that in April. You're creating money kind of out of thin air. In addition, because you own an interest in this project and it is producing electricity, which will then be sold to someone, you get a share of the revenue. And that share isn't very big. It's about 2% annually. So if you put in 100, maybe you're getting $2,000 a year. On its own, that's not a great investment return and not a reason to do this. But add it to all the tax savings and it really adds up. And you can stay in this project for anywhere between 5 and 30 years. So that's a check that you're going to get, and that just comes to you for as long as you want it. And then at some point, you'll sell off your interest. It's not an appreciating asset. It loses value, and so you'll sell for a fraction of what you paid, but all of these benefits more than make up for that decrease. And you end up coming out significantly ahead as compared to if you just took that money, paid your taxes, and invested in the markets and grew that money over the years. Somewhere in the range of 4 to 5 times higher overall returns after taxes compared to if you just paid your taxes and reinvested. The one other main, I guess, major point I want to make here is that if, or I guess two procedural things here. If you decide to do one of these solar projects, the first thing is this only works if you are able to and allowed to materially participate in the project. This is a side business. It has to be, because the IRS only lets you use these tax benefits I've described against your earned income, like W-2 and business income, if you are an active material participant in the project. What that means is you have to spend 100 hours helping with the business every year that you're claiming tax benefits. So definitely in the first year and maybe in future years. And that means visiting the site. It means meeting with the developer. It means tracking production of electricity, watching videos, going to conferences, becoming a participant for 100 hours. And either you or your spouse can do that. That does mean, and I think it's relevant to this community here, for most, in fact, I think all H-1B visa holders, this is not going to work because you are precluded from having a side business. If that's true, there are a few different ways that we can get around that via, I guess, modifications to this approach. And I'm happy to talk about that with kind of individuals as they're interested, but it's worth having in mind. The other kind of upshot or result of that material participation requirement, along with the requirement that the project has to be physically completed and plugged into the grid in the same year that you want the tax benefits, that means you've got to get this done, all, including your participation and building the project, by December 31st. And what that means is you really got to get started soon. There was a first wave of solar. I know I'm seeing some names here. I think some of you are on our mailing list, and you'll know that the first round of solar closed September 1st. Those were the projects that we were confident were going to be completed by the end of the year. We've now rolled out a new tranche of inventory, and we do have projects that are still available and will be completed by the end of the year. So this is still doable, but time is getting tight. And so if you want to pursue this, you should get in touch with the iNRI team, who will bring us in to talk about it together. And you should be getting in touch and starting to think about this seriously in the next couple of weeks, so that we can have a serious conversation and start the process during October. And that'll give you enough time to spend your 100 hours and complete the project. And then of course, next year, this will be available again. One very common question is, how does this interact with US politics? What did anything about the big tax bill in July change this? Does anything about the current administration change this? And the answer is not really. In fact, the July tax bill strengthened solar, strengthened this project in two ways. First, it solidified it through the end of 2027. So we have this year and 2 more years for sure to do this. It also instituted this large first-year depreciation right. It's called bonus depreciation. It also offered a way to extend the benefits through 2030 that we're working on with our lawyers. So just the bottom line is this is all well established, it's clean, it's available for the next 3 years at least. And so we'll be happy to talk about it for this year and or for next year. The qualification number here really is if you're earning, anywhere north of, I'd say, $300,000 a year, it's worth thinking about. Most of our clients are people who are earning 500,000 or more, and our median client is earning about $800,000 a year. But we have people who are earning 200 and people who are earning 40 million from their, RSUs that have gone crazy this year or their business. So a very, very wide range, and this applies to almost everybody in this group here. There are certainly other things to talk about here, risks and limitations and things like that. I'm happy to get into that, but that is, I think, a fair overview of the program.
Jeff, there are a few questions on CRT and solar.
Yeah,
should we go through them?
Yeah.
So starting from the beginning on the charitable like CRT,
Mhm.
can options and futures be bought through CRT or
Yeah,
what?
very, very good question. There's a little bit of complication here around whether there's any kind of version of that that looks like taking a loan. And the best interpretation that the accountants and lawyers will give you is that kind of uncovered naked options are a strategy that might violate some rules. And so we'll have to look closely at exactly what you're buying and how. But covered options and futures should be no problem. You can do that. And so we have clients who are doing a covered call strategy with Tesla or Nvidia. Plenty of that is going on, and absolutely you can do that.
The second one is, can IRA funds be transferred into CRT?
Very, very good question. There are, as everybody knows, I think, or most know, there are two kinds of IRAs that are relevant. There's traditional and Roth IRAs. If we're talking about a traditional IRA, you definitely can't remove assets from the IRA and put them in the CRT unless it's a distribution, in which case you can do whatever you want with the money, but it wouldn't be advantageous. You can't use IRA funds while they're in the IRA to put them into a trust. Those are two separate entities. And so, in general, with a traditional IRA, they don't play that nicely together until you pass away. In which case, there are strategies that you can use where you roll your IRA into a CRT, and that has tax advantages for your descendants, for whoever you're giving the IRA to. Essentially, it allows them to spread out the distributions from the IRA and reduce the tax rate. But that's really for end of life planning. We can do that planning when you're kind of getting up there, but it's not something that you'll really put in place now. For regular IRA assets, they can't really move from one to the other. They have to stay in the IRA. With a Roth IRA or with an IRA where you are converting to a Roth and you have a big year where you're doing that and you have income, you can take some of those proceeds, distribute them, and put them into something like solar as a way to offset that annual income. So we do see people doing a Roth conversion and taking some cash and putting it into solar. That's a reasonably common strategy. But again, it wouldn't be going from the IRA directly to a CRT.
I think that answers the third question. Can the trust be inherited to successor? I think you answered that.
Well, so kind of. You can do it the IRA thing where you move the IRA into the CRT and then it goes to your successors. You can also, I'm going to take this opportunity to talk a little bit about the length of a CRT, how long it will last. You can set up a CRT for either a fixed term of up to 20 years or for a lifetime. Let's say I'm putting $1 million of Apple stock in. I can set the trust up to last until I pass away. I can set it up to last until the second of me and my spouse pass away. So if my wife outlives me, it lasts until she dies. And also what you can do, and this goes to the inheritance question, you can set this up for your life, your spouse's life, and for a term where your kids would take over ownership of the trust. That's a very common strategy. You don't need the money right now. You want it to go to your kids, and so you do a trust, and I'll talk about this next, where you defer all of the income. You don't take any money out of the trust. You let it grow and grow and compound. And then your kids take over when you pass away, and they take the income for 5, 10, 15, 20 years. Okay. That's a kind of a more advanced move, but it's something we do a lot. And really the point is big picture. These are very flexible and a way to involve your kids if you want to or not. The principle here is the longer the trust lasts, the higher your overall returns because you're compounding tax-free for longer. So it is very common to do lifetimes and reasonably common to add your kids as well. Okay. The other big kind of moving part with CRTs is the format of the trust, and that has to do with the distributions, how and when you take distributions. So the baseline is that you will be entitled to take out, let's say, like I said, it's somewhere between 5 and 11%. Let's say for you it's 7%. The baseline is you get 7% of the assets every year. If the trust is worth $1 million, it's going to pay you $70,000 no matter what. You can't say no, you can't take more. That's it. Um, and that's called a standard CRUT or standard CRT. Um, an enhancement or an optimization that you can pursue is to do what's called a NIM CRUT. Again, I'm not going to go too deep into this here now. Happy to answer more questions if people have them or talk individually. But the basic idea is that a NIM CRUT allows you to defer the income from the trust. If the trust owes you 7% and you don't want it, you can pass on it and let it roll over to next year and add it to next year's amount and accumulate a good amount of money in the trust, and then either you or your kids take it out when you need it. And the reason you would do that is, well, you're paying tax when you pull the money out. So if you don't need the money, let it stay in the trust, defer those payouts, let it grow, let it compound, and then take the money out down the road when you really need it. And that is a very common strategy for our younger clients. I'd say anywhere kind of under 55 or so. Over 55, maybe equally common to do a NIM CRUT or a standard CRUT. There are many, many more optimizations to be discussed here. I don't want to kind of go too deep. You guys tell me if you want me to. I'm happy to, but I don't want to kind of overdo it here. I think those are the features that are maybe most relevant, or kind of most worth talking about. So
Makes sense.
yeah.
There are a couple of questions on solar projects as
Mhm.
well. One, is there a limit on how much can be invested in solar
Yeah.
besides what's the tax liability?
Yeah, very important question. There is no theoretical limit on what you're allowed to put into the project, but there are some limitations on the benefits that you can claim. And so that usually sets the ceiling on what people want to put in. So the way we calculate the tax savings here is we start with your income. Let's say you make $1 million a year. And then let's say you put $200,000 into the project and that yields $360,000 of depreciation. We subtract the depreciation from your income, so that million becomes 640,000. Then we calculate your federal tax bill. So on 640,000, maybe you'll owe something like 200,000 in taxes. Um, and then we take the credit, and you are allowed to take a credit on that $200,000 tax bill of up to 75% of that bill. So in this case, that would be $150,000. So there's a limit of 75% of your taxes for the credit. And also at the higher levels, there's a limit where on W-2 and RSU income, the most depreciation that you're allowed to take as a married couple is $620,000 or so. Most people aren't hitting that limit, but some are. And so it's important to know $620,000 of depreciation. Although if you run a business, there's no such limit. You can write off all of your business income. And then a 75% reduction of your taxes via the credit. And that yields an optimal number. And our modeling will tell you, based on your income, here's the optimal project size that maximizes the percentage return, right? If you because there are kind of additional state tax benefits that aren't capped, theoretically, every additional dollar gets you some tax savings, but it's a smaller and smaller fraction. And so the return, which, as I said, if you're under these limits, is somewhere in the range of like 140% in the first year. Um, if you go over the limits, the total return goes up, but as a percentage of what you're putting in, it goes down. And so what we'll tell you is here's the optimal project size such that you're maximizing the percentage return. Some of our clients decide, you know what, I get it. I'd like to invest more. I know I'm going to get a smaller percentage return, but I want more credit. And yeah, I'm over the depreciation limit. Oh well, I'll use that next year. Because if you're over any of these limits, it just carries over next year and for up to 20 years. So you can go over, I'd say 95% of our clients stay under those limits. And so if you're earning $1 million, the investment size is usually going to be in the range, the maximum is going to be in the range of like $400,000. That would yield depreciation of about 600,000 hitting that cap, and then you'd reduce your income. It'd be like 400. Your tax bill might be 200, and then you could use 150,000 of credit, which on a $400,000 purchase would actually be about right. There might be a little bit of leftover credit, and you'd carry that forward, and that's fine. We'll do the math and we'll help you find the precise number, but I'd say that, if you're making 1,000,000, 350 or 400 is a very common number. If you're making, let's say, 700,000, then more like 200,000 is a more common purchase size. But we can do whatever. We have the inventory and the projects to do very large things. We just had a client who one of our clients made $40 million this year, as I said, and he chose to do a $7 million project. Even understanding that he was going to hit that depreciation limit, he was happy with it. He'll use that depreciation over many years. So,
Got it.
very flexible.
There was one more question. The percentage of revenue that you mentioned, around 2%, is that on the investment amount or the project value?
Very good question. It's not really calculated against either of those, right? It's not like it's actually a percentage, but it's really just a percentage of the revenue from the project. But the estimate is that that's about 2% of your purchase amount. So if you do 200 and the project is 4, you're getting about 2% of the 200 every year. So $4,000. That's a good question. Yeah.
I think those were the questions that I found you on. There was one more about if this credits can be scrapped. You already answered it, that the new tax bill has actually strengthened it more than.
Fortunately, we're good. Given that we have a few minutes left, I suppose you guys tell me if there's anything else you want to talk about. I might touch on the kind of downsides of these two things, of these two types of projects. Neither one has huge downsides, but I think it's worth spending a minute on them. For charitable trusts, this is an easier one. The main downside, really the only downside or constraint, is that your income, your liquidity from this trust is limited, right? As I said, it's going to be somewhere between about 5 and 11%, usually around 6 or 7. If you're selling, let's say, $3 million of company stock, and you want to take that money and turn around and buy a house, then this isn't for you. If you want to take that money and put a bunch of it into your kid's college fund or a renovation or buy a boat, this probably isn't for you. If you just want to have that money free and clear with the option to spend it, probably not for you. This is going to yield a percentage every year, and that will accumulate, it'll add up, and it will become quite liquid. By about year 8 or 9, you'll have the same liquidity that you would have had if you had done no tax planning. And then, of course, over the years after that, you'll do even better with the trust. The break even is about year 8 or 9. But if you really want access to the money in the earlier years than that, then this might not be a fit. And so this is a long-term play, or at least a medium-term play. This is for people who have their other needs met, who don't need the income, or who like the idea of a steady 5 to 7% and are using this kind of like a retirement annuity, or plan to do so in the future, not for a lump sum to go and spend. So that's very important. It's not really, not usually a constraint for most people, right? You all are doing very well and you've got other money. This is a way to maximize the total return, even if it means kind of constraining yourself a little bit on liquidity in the early years. On the solar side, I want to talk about a few potential risks. I'm a lawyer. Some of you have heard me say this before. I'll never say something is risk-free. Solar is not risk-free. There are a few risks that I think are theoretical risks, but not practical ones. And then there's one practical risk. So the ones that are not really a practical risk, even though they're theoretically there, the project has to be real. It can't be vaporware. It can't be fraud. And so if you invest with a developer and they never build the project, you don't get your tax benefits. You need to make sure this is real. Of course, part of Valor's role is we vet our developers. We make sure these are real projects. All of our developers have a 99% plus project completion rate. this is real. It'll get done. It'll get done by the end of the year. You don't really have to worry about that. But of course, you'll do your own diligence. You'll meet with the developer. You'll look at the numbers and the plans. Um, One way that we make sure this is going to happen is that we require all of our developers to pull permits and put shovels in the ground before you even come in with your money. And that way it's far along, it's proven to be a real project, and you have confidence there. The second risk, which again I don't think is a real risk, is the project has to stay online and working for 5 years. If it fails before that, there's a pro rata clawback of the tax benefits. So if the project fails at the end of year three, there's still 40% of the project of the 5 years left, and you would have to give back 40% of your tax benefits. So we need to make sure that the project actually continues for 5 years. Again, it's not a real risk. Every project is fully insured, and the developers commit in their legal agreement with you to keep the project online, and they have an economic incentive to do so because the way they make money is off of the ongoing revenue. We've had no projects that have failed and not been brought back online. Um, the riskiest thing here is acts of God, right? Many of our projects are in Southern California. What if there's a wildfire or a landslide? Or on the East Coast, what if there's a hurricane? Well, there's insurance and there's a safe harbor amount of time where you're allowed to rebuild over a few months. And like I said, 100% of our projects have been rebuilt. We've only had a couple where there was a fire on a building or whatever, and those have been rebuilt and went for 5 years. So again, that's not a real risk. The main one that I want people to understand is not a huge risk, but something you really have to understand is the regulatory risk around material participation. This is the idea that, like I said, you have to spend 100 hours in the project to use these benefits against your earned income. And the risk or the challenge here is that the IRS has not been very clear about what sorts of activities qualify. We do have some information. Although Valor hasn't had any clients who have been audited on this question, which is good news, our accounting partners, some of them have had clients go through audit. And so we've seen the kinds of questions the IRS asks, and we've seen the types of activities that have been approved. So we have a good idea. But because there's no formal IRS guidance or case law on this question, it is a bit of a guessing game and a risk that the IRS could change their mind and decide to say that the activities that we think qualify do not. There's a few things that protect you here, even if that did happen. The first, or I guess that protect you from that happening. The first is it's never really been done. This administration would be the most hostile, I suppose, to this sort of thing. It's solar. They don't love it. There have been no audits. They haven't invalidated anybody on this, as far as we know. It's been totally defensible and fine. And then in addition, if the IRS ever did decide that you didn't qualify under the material participation rules, what happens is that your benefits are suspended. They're not eliminated. They are suspended, which means paused. And then you would get to apply them to next year and try again to qualify. And so what you would do is you'd sit with the IRS agent who audited you and who invalidated it, and you would ask, what sorts of activities do I have to do? They would tell you, you would do them, and you would use the benefits next year. That wouldn't be ideal, of course. You're getting the benefits a year later or 2 years later, but it does mean that there is some hedging or some protection here in the event that an audit happened and was unsuccessful. Like I said, this never happened to us or our clients. We have no reason to think it's going to happen, but because it's not just a theoretical risk, but a practical one, I think it's important for everybody to understand. And you can kind of evaluate that. I'm happy to talk more about it, but that's how I think about it.
Great. Thanks, Jeff. I think amazing insights today. I'm sure the audience is going with a lot of uh, I think clarity. I'm sure like these names people have heard about before, but today I think gives them an opportunity to definitely learn more, but maybe take an action that will definitely, help save them a good amount of money.
That's right.
Um, I think I had one question. Maybe I
Mhm.
could put it given the interest of like we do have some time.
Yeah.
So regarding the CRUD, is it a way like let's say if we need liquidity before to close it, or there's no such way?
Yeah, good question. Theoretically, yes, but practically, no. You can close it, but all you get back is the discounted present value of your future distributions. You can't take back the principal. And so what you get back is a small fraction of the total value. And so it's not optimal. You'll lose a lot of money by doing that. So we want you to be very careful and not do this unless you're reasonably sure you want to continue forward with it. That being said, there are other ways to get liquidity. It's not easy, but you could theoretically borrow. You can't borrow out of the trust, but you could borrow against the future income. So if you have a private banking relationship, and we can help with that, we have contacts. You can borrow against that future income stream, and that's a way to get some liquidity if you need it in the early years.
Right. Got it.
Okay.
Great. I think there's one question by James. Do we need to itemize deductions to take advantage of these?
Good question. On the CRT, the answer is yes, I guess if you, well, I guess actually, iNRI guys, you probably know better than I do whether you need, I don't think you need to itemize to claim a charitable deduction, right? You can add that to
Yes,
your,
you don't really need to itemize for either of these two options.
yeah, that's right. So on the CRT side, you can use the charitable deduction up front, the 10%. It's above the line. You don't need to itemize. And then for the main benefit, which is selling tax free, that's completely separate from your personal return, so no itemization. And then on the solar side, this is totally separate. Again, this is a business interest with business credits and deductions. They're passed through to your personal return, but it doesn't depend on itemizing. So good question.
This charity distribution is like deduction is completely different from the regular donations that you would be doing to charities. It's a whole different category.
Yeah. So if there's any more, happy to answer, but I'll say big picture, if any of these are interesting, as I said, get in touch with iNRI. They'll connect you with us. If you want to come to us directly, it's valor.com. We always track where people are coming from, so we'll bring in the iNRI guys as necessary to make sure that they get credit and get to stay involved with what you're doing. But with like I said, with charitable trusts, get in touch when kind of early in the game when you think you might be having a capital gain. Let's chat. Let's talk about it, and we can help you make a plan and then act when the time is right. I just want to be very clear about this. I mentioned it briefly. We don't charge anything for our planning consultations, and we don't charge anything for the actual setup of these vehicles. So you can work with us as much as you want until you actually fund the thing. You're not paying a dollar. So no barrier to entry here, no reason not to get in touch and at least chat about this. We're happy to talk with everybody, really as much as you need to understand these things and decide if they're for you.
Yep.
And the same thing goes for Go INRI as well. You can set up a free consultation call whenever you want. Just register on our website, set up a call with either Hemant, Dinesh, or me, and we can help you understand where you stand and what strategy suits well for you.
That's right. And if you do end up kind of coming in to talk to us, if you decide to come to our site at all to poke around, and you can do that to read, check out some materials, you'll be asked. Just make sure you put in the sign up that you are working with iNRI. We'll ask when you go to set anything up. So not a worry from any end, but might as well try to keep track of that. So let us know that as well. And yeah, we're here to help.
Great. Thanks, Jeff. Again, I would like to take this moment to also talk about our upcoming things and also our 1040 analyzer, which will essentially help you to identify tax savings and also discover opportunities such as solar and take advantage of that. So let me share. Hmm. Yep. Okay, so we have this 1040 analyzer set up. It's basically a tool that if you put your 1040, it will tell you that, hey, these are the strategies that apply to you directly. Uh, Definitely, it will give you a range, and the idea here is to identify, where you can begin, and then work with the INRI team closely to help realize these savings. And this tool is completely free, so you can go today and check it out on the platform and get a free tax plan. once you are interested, you get in touch with us, and then we help you implement and realize these savings. So yeah, easy way to get started. Sign up for tax planning. We offer year-round strategies, tax loss harvesting, personalized services regarding your objectives and goals in the future. Also, a quick insert. If you filed a tax extension earlier this year, then it's time to file your taxes before October 15. So we help with both filing and planning, and definitely feel free to get in touch with that. So Dinesh, I believe, has shared a bunch of these links, which should be handy in the Zoom chat. We will also be sharing this as part of an email for all who have registered for the event today. And we will also be sharing the recording, so stay tuned for that as well. Coming next is a webinar series. We are doing this next weekend. This is Saturday and Sunday, September 27 and 28. I'm sure this would be very exciting for the audience that we have. The first one is on US India tax compliance, as a lot of NRIs, who have these cross-border finances, assets, and income. We would definitely go deep dive onto a lot of these assets and how to think about it, how to plan it right, and make the most of it. And the second webinar is on estate planning. So this is on succession, inheritance, wills and trust, and this will be both covering India and US. So definitely a topic one should look for. Great. So we are at time. Thanks, Jeff. Again, it was great to have you, learn from you today, and look forward to working together.
Yeah. Thanks, everyone.
Yes.
Thanks, Jeff.
Thank you,
Appreciate
everyone.
it. Thank you, everyone. Thanks, Nilesh.
Thank you, everyone.